On August 11, 2026, Cardinal Health released a fourth-quarter earnings report that presented a classic, unexpected market paradox. Bad news hit the wire, yet the market reacted with aggressive optimism. The initial numbers looked weak. The company reported $63.67 billion in quarterly revenue, falling short of Zacks consensus estimates by 2.9%. But instead of punishing the stock for missing its revenue targets, buyers stepped in. Shares of Cardinal Health jumped 3.7% in pre-market trading. This creates a distinct analytical question. Why would institutional buyers actively bid up a stock that just failed to meet its baseline volume targets? Revenue composition dictates how the market absorbs a volume miss. When underlying earnings show structural margin expansion, absolute volume targets often become a secondary metric. To understand this dynamic, we need to look at the broader timeline. Across the full fiscal year of 2026, Cardinal Health generated $254.25 billion in total revenue, marking a healthy 14% growth rate year over year. But in the fourth quarter, that top-line growth decelerated to just 6%. While volume slowed, the profitability profile did the exact opposite. We can see this clearly by looking at the fourth quarter adjusted earnings per share. Adjusted EPS jumped to $2.91. That is a massive 40% year-over-year increase. That $2.91 figure comfortably cleared consensus estimates by a margin of 20.3%. This rally reflects a rational weighting of priorities. The 20.3% bottom line over delivery provided significantly more market value to investors than the 2.9% revenue miss took away. To locate where this leverage was generated, we must deconstruct the income statement. Tracking top-line revenue down the statement and peeling away operating expenses, we see a clear decoupling of volume from profitability. The final EPS output scales up disproportionately relative to narrow top-line growth. This degree of margin expansion requires a highly specific internal mechanism to drive that operating leverage. Cardinal Health successfully decoupled its absolute profitability from pure volume growth. To find the engine behind this, we need to dive into the segmental performance. Breaking down the operating divisions isolates where this leverage is coming from. The primary driver for the beat was the Pharmaceutical and Specialty Solutions segment. This chart shows the segment's top-line input mirroring the overall company. Revenue increased a modest 6% year-over-year, reaching $58.85 billion. Contrast that modest revenue bump with the segment's profit output, surging 21% year-over-year to hit $645 million. Look at the stark asymmetry of those metrics. Absolute profit grew 3.5 times faster than the underlying revenue. Generating 21% profit growth on just 6% revenue growth is the exact mathematical foundation of the firm-wide 20.3% earnings surprise. What specific operational factors allowed the pharma segment to extract that much more profit from such a small increase in volume? The earnings report points to two main catalysts. The first is robust brand and specialty pharmaceutical sales, driven by existing customers. The second catalyst is positive performance metrics within the company's generics program. The financial mechanic at play here is product mix. Specialty drugs and generics carry inherently higher margin profiles than standard wholesale distribution. By shifting its product mix toward these higher margin categories, Cardinal Health is extracting significantly more absolute profit dollars through its existing distribution infrastructure, without needing to drastically increase overall volume. Historical data explains the fourth quarter, but institutional investors use forward-looking expectations to actually price the stock today. Management set their adjusted EPS guidance for fiscal 2027 tightly between $12.40 and $12.60. That guidance implies a projected earnings expansion of 13 to 15% for the upcoming year. After a top-line miss, the market treats forward guidance as a strict test of management's credibility. The stock rallied because this strong 2027 guidance confirms that the fourth quarter margin expansion was not a one-off accounting anomaly. It is a durable, multi-quarter trend. We can contextualize the market's enthusiasm by mapping Cardinal Health's year-to-date performance against broader benchmarks. This chart tracks the baseline metrics. The medical and dental supplies industry benchmark posted a 5.9% year-to-date gain, while the broader S&P 500 climbed 13.1%. Cardinal Health clearly outperformed both, climbing 15.4% year-to-date and easily beating the industry average and the broader market. This outperformance connects directly to the forward guidance pricing model we just discussed. Cardinal Health's outperformance demonstrates the premium market's place on high-margin product pivots. By successfully shifting its structural profitability, the company has managed to separate from its industry peers, even while falling short of its own volume targets.